Hey, what's up, guys? I'm gonna show you today how I trade SPX the last few minutes of the market, starting kind of like from the last 30 minutes or so, and kind of show you what I'm doing, the indicators I'm using, and the strategy I'm doing. So, first of all, these indicators, I grab them from Sati, from satiland.com. He has a bunch of free indicators and great education both on YouTube and Twitter, which is where I mainly watch his information. So I have these four indicators: the ATR levels, pivot ribbon, volume stack, and phase oscillator. And basically, if you go to his website, satiland.com, you can find the links for Thinkorswim or TradingView, whatever you like to use. And so this is what my screen looks like. You have the pivot ribbon, the ATR levels, and the phase oscillator right here, and then the volume stack. So just a quick recap. Here's one. Basically, what I'm trying to do is find divergence between ES or SPX and the phase oscillator to enter trades. And so usually around 30 minutes or kind of like an hour into close, I start looking at the market at ES or SPX and observe for divergences. And they kind of start to happen like, at 30 minutes or so before market closes. Let me show you an example here. So this one here you see we made a lower low, but then you see the oscillator down here kind of didn't. So you have that divergence, and this can tell you, hey, let me get into a call. Um, for SPX, the 5820 call was pretty cheap around that time. Can't remember how much it was, but what you do is you enter something that's not too out of the money. Maybe two strikes or even one strikes. At this point, SPX was at 5809, so 5820 is something feasible that you can think like, hey, I think it's gonna reach the same, some equal highs around here. And it's not too crazy to where you're not getting like the 5850 or something where, we have 30 minutes left into the market and the probabilities of that going to the money are low. So then you're just going to be risking basically your money, risking it to go to zero. And here you can see it on SPX as well. So I like to look for it both SPX, ES, see which ones have cleaner divergences. And one thing to note is you want them to be kind of like at the bottom. As you can see here, we're like nearing the bottom of in the oscillator. It's nearing negative 100. So it's kind of telling you like, hey, this is giving me a chance that it'll ramp up compared to having it here in the middle where it's compressing. So then as you can see, if I press play, eventually we hit the target. And what you can do is either buy one contract and be willing to risk it, because this, as you can see, can turn around quickly. And buy one contract, get out at target, and then, or you can buy like, let's say three, and you trail stop, you get out, get out around here, get out here, and then finally get out here. And if you really want to risk it, leave a runner. But I noticed that we have these type of trades happen pretty often in SPX at the end of the day, and because data is burning contracts, it becomes a really solid trade. So let me show you an even better example from, let's see, we had a really good one on Thursday. So on Thursday, I noticed that throughout the day, and this was, I used the 1 minute and the 3 minute around the end of day to look for these type of plays. And so the 3 minute was a bit more clear. And I kept noticing that um, SPX kept making higher highs, but the oscillator wasn't. And so I noticed too that it was lasting a long time. It kind of happened about an hour before close. And it made me think, you know what, this might really start to drop if it does. And another thing that I use is the SPX leaderboard. And Sadie actually has a video on how to build basically your own leaderboard in um, Thinkorswim, but I'll link it. I'll also put a link in this video. So basically, and unfortunately, the market's closed today, and I can't look at the previous day's data, but what you're going to see is basically what has the highest volume. And um, especially towards the end of the day, if you start to see some things like 100K volume, it could grab some attention. But then also, what, like for example, right now we are, on Thursday, we were kind of pumping. So all of these, like the 58.75, 58.60, 65, all those calls were in the money. So towards the end of the day, the market makers might want to shake those out. And so let's say, for example, those were the highest here, and they're in the money. Basically, towards the end of the day, the market makers want to kind of shake that out and make those go to zero or lose value premium. And so, because we're making these highs and we have this divergence, you're going to start to look for puts. So around here, I remember I actually grabbed the 58.60, and I think I grabbed it for $1.50 or 150 bucks. And so then this started to kind of really fall. And at the end of the day, we ended up closing 58.40. These went from $1.50 to $20, I think, at its highest, so more than 1,000%. I sold for like 300%. Um, but in retrospect, sometimes when we have these bigger divergence, we probably will have a bigger move. If you notice, like you could have entered here, or even like this gave you an opportunity to enter, but this move started to happen 30 minutes into close. And like I said, 12 minutes into close, you could have entered as well if you missed the move. But this was like one of those days where you could grab risk one contract and let it settle, and you would have had a good trade, or you can grab more and kind of have trail stops. So basically, what I'm looking at in these end of day moves is that divergence between these two. I'm looking of what's on the leaderboard, and like if there's a lot of things in the money in the leaderboard that are calls, then maybe I'm like, yeah, they're gonna try to make those go to zero. So I start looking for puts, and like I said, I start looking where I'm like not too out of the money, trying to pay less than $2. The closer you get to end of day, like you can even set it like limit fill you at like 80 cents or something where it's like cheaper. And then as I'm selling, I either have it limit sell to like 100% or 200%, or I sell it at market if it's starting to move too fast. But basically, I'm risking 1 to 2 contracts max, and it's an amount where if it goes to zero, if it doesn't go my way, then I'm okay. You live on to trade the next day. But basically, you can find these moves at end of day. A lot of times here, like I said, look for that divergence. It's not always clear, but for example, here we had this and we had this. And as you can see, the last 30 minute, the last 30 minutes or so, the market started to move. Um, and like I said, you can use them throughout the day as well, any time frame. The bigger the time frame, the most likely bigger the move. Um, for example, I think these, let's see, look right here on the hourly, we were making higher highs, and then the oscillator wasn't. So this could have been a good, you could have swung some puts and that would have paid. So like I said, the as you're doing this throughout the day, to look at the context of the other time frames. Are they also kind of like towards the top if you're looking to go short? Um, because that'll have a higher probability of it kind of turning into a trade. Because if it's consolidating or if it's not matching, meaning like let's say the you're looking at the 5 minute and the hourly, you're looking for puts, but the hourly, let's say, is down here already, you'll likely have a better chance if it's the hourly is higher in the oscillator. Then you use the volume, of course, to see what, if you have more buyers than sellers and vice versa. So that's kind of like what I look at it. I also look um, at the periscope on unusual whales and kind of see where they're trying to pin it. For example, towards the end of the day, I try to see if puts or calls are growing, and what strike is kind of growing, meaning that they might want to target that. And like these dots will tell you like where the previous one was. So you know, um, this one was telling me that it was kind of growing. So if you're up here, for example, and you're in the chart, let's say when we had this move here, and the chart is showing you a divergence, and this is showing you, hey, they might try to come down to the 5800. You can try and do like 5805 or go 1 or 2 strikes out, and then you could be in the money. It'll tell you like, hey, this is trying to come down. And so that's another thing I use throughout the day to look for those divergences, and then to look to see where market makers are positioning themselves towards the end of the day. And like I said, the leaderboard and these indicators. So basically, I've just been using this for a couple of weeks, and I've been kind of seeing the pattern. So as I keep seeing the pattern, I keep trading those last 30 minutes. Basically, you start looking for gamma, you start looking for divergences, And if they start to align, like if they align with the pivot ribbon as well, like if you see a divergence that, is rejecting the ribbon, or like here it's started to switch, like I said, here we started to reject right here, and this is like a good entry to get scale in for puts. And I noticed these happen, you get like the really juicy ones like once a week or so, and then but overall you can kind of find it almost every day. And like I said, as long as you don't over leverage, maybe play with profits or play with like just one contract where you're okay with losing like $100 or something, instead of like saying I'm going to put all my money in this and then you're trading emotionally and it may or may not go your way. So yeah, I've been using this strategy for a few weeks now, and if you have any questions, let me know.